CMBS 3030. This is the first one of these that I'll be doing, and I'll talk more about it here in a minute. But this is Ann Hambley. I'm the founder and CEO of First Service Solutions. And for those of you who don't know, I created First Service Solutions in 2005 as the first CMBS borrower advocate. And this last year, we worked with on over 600 COVID relief requests. So we live daily in the CMBS space, and I'm sure, as you all likely know, CMBS loans don't work like bank loans. And for people that didn't know that pre-COVID, you surely learned it during COVID. Bottom line is that everybody else in the CMBS structure, the master, special servicer, etc., are all hired to protect the bondholder. So there's no one representing owners, and that's why I created this space in the industry. And CMBS loans are governed by IRS regulations and SEC regulations, and most borrowers have better things to do than to try to learn all those regulations and then understand the motivations of the parties in the pool their loan is in. So anyway, that's why we're here. One of the reasons I have these, I created these CMBS 3030 calls is to inform you of what's going on in the CMBS industry, what types of deals are getting done, and other sort of inside information into the workings of servicers. You can find out deal transactions, many other better sources. This is going to be inside information about what servicers are doing and what we're seeing. Today I'm covering the following hot topics. And by the way, if you have anything you'd ever like me to cover in any future 3030 call, please just shoot me a note and I'll gladly cover it in one of my next calls. These calls are going to be 30 minutes every 30 days, and hopefully you've all, well, of course you've all signed up, so you should be aware when they all are going forward. So today, again, I'm covering how to address the mismatch between what you need for COVID relief and what we're seeing approved. We're going to talk about, many of you are seeking outside capital to help bridge the gap for COVID, and I'll go over some of the requirements of the servicers in that situation so that you're aware of them early on and can plan accordingly. And I'm going to talk a little bit about when defeasance can be waived, when you can get an extension of your maturity date, and kind of how those are being viewed by servicers. And probably the most important one I'm finding is how the current LTV with these depressed values impacts purchase and sales and servicers mentality kind of going forward. So those are the main topics of today's 30 minutes. And I'll start with how to address the mismatch between the need and the relief offered. And every single day we meet with borrowers, and every borrower is feeling the same thing. And I know you're probably all feeling it. But most special servicers at this point have granted or are granting COVID relief. I mean, for the most part, the theme is that borrowers are getting relief. There are some exceptions. It's all in the form of deferral, meaning it all has to be paid back. And the terms of the deferral range from 6 months to 18 months. And just because I'm saying this doesn't mean everyone on this call could get the 18 months. So as with all commercial real estate, everything depends, but I'm giving you general feedback. So we're not seeing them much beyond 18 months. All deferred amounts have to be paid back over time. And you typically start paying that back shortly after the deferral period ends. The rule of thumb is, in general, is if you get 6 months relief, you pay it back in 6 months. If you get 12 months of relief, you pay it back in 12 months. Not always, it doesn't always hold true, but that's the general way to look at it. The deferred amounts have to be guaranteed by the current guarantor. And really the logic there is to prevent all of us from kicking the can down the road and then planning to sort of later hand back the property. It would be easy to get a year deferral and then just plan to hand it back then. And so the one way that servicers are trying to ensure that doesn't happen is by having the sponsors or the guarantors guarantee the deferred amount. Now there's fees for the deferral. So basically what you get at the end of the day with this deferral is you get time and you pay for it, but eventually you have to pay it all back. So there's no forgiveness. And I know that you're in a position where a lot of your properties have forever lost a big chunk of revenue. And unfortunately, you're not forever getting relief on the debt. You're just postponing it. Again, longest deferral so far that we're seeing is through year end 21. And the longest payback period is 24 months beginning in 22. That's probably the long end of the spectrum. The problem with that, so that you might be saying, well, that would be fine for me. But the problem with that, as you probably all can see or know clearly, is that in most, well, not most, but I'm going to say in some places and some property types, that isn't enough, right? And it isn't enough in a lot of cases. We have a big conference hotel in New York we're working on. Think of that. It's not going to recover by year end 21. There's no way the borrower can make one plus something else payment in 2022, right? So the only way that I'm aware of to handle this kind of situation is to take the forbearance that you're being given, which they're not being offered. You have to claw and fight for everything. But what you end up with, take it, and then know that you may be and likely will be in a position of needing it extended again or asking for more. We're just basically at that stage in this industry, but we are seeing servicers being reasonable, in air quotes, with further extensions. Many servicers are agreeing that they acknowledge that they're going to have to kick the can down the road a number of times. Now, will it cost you a fee every time? All that remains to be seen. I would assume there will be some fees in all cases. So it's not, the COVID relief is not a windfall. It's not a complete relief. It doesn't allow you to sigh, take a big breath and celebrate, but it does at least kick the can down the road, right? So since that doesn't give you all the relief you need, many people I know are seeking outside capital to help bridge the gap for COVID. So I want to go through a few of these and explain how they work. First of all, I'm going to cover, this is a little bit disjointed here, so I'm going to cover a number of things. But the first thing to address when you're bringing in new capital, so let's say you're staying in and you're bringing a capital partner in, JV partner or limited partner, if that partner is going to have any control rights in the borrowing entity, which typically they would, but if they are, then they need to be approved by the servicer, and they will likely have to step in and also serve as a carve-out guarantor. So know that when you bring in an equity partner, you can do it all day long, usually in your loan docs, if they have no control position and they're a limited partner. But when they step in and have control rights, you need to get approval. And again, they likely will require to have also serve as a carve-out guarantee. Now, another thing to think about is how the servicers will address loan to value. Loan to value is going to be the theme over the next couple years in CMBS. Let me tell you why. So let's say that you were going to sell your property. We have a number of people deciding to do that. I'm going to sell the property, bring in a buyer. We're going to talk about defeasance next. The buyer has only two or assume the loan, right? Defease it or assume. Can everybody hear me okay? Susie, are you still hearing? Know that maybe to make sure everyone can hear me fine. there is a disconnect. Value the property's 10 million. So let's say that would be a current loan balance of 7.5. Let's just say the loan balance is 7.5 million. You decide to sell the property and you sell it for 9. Okay. Now what the servicer will do is they'll want that LTV to remain consistent. So to have a 75% LTV loan with a $9 million value, a loan balance would need to be in essence 6.75 million. The difference between the $7.5 million loan and the 6.75, which is 750,000, has to be contributed typically by the buyer, and it will be unfortunately held in a reserve. It cannot be used to pay down debt. So with CMBS, you can't delever. You're actually going to be contributing money to be held in a reserve as additional collateral. Now, that will kill every deal in this depressed valuation market. So we have approached many servicers, and we have worked on a few where the transfer of ownership was taking place due to a sale. You had depressed values due to COVID. And the servicers, it remains to be seen how they're going to approach this overall. But in general, what I will tell you is they have been willing to look aside on the LTV, especially where it looks like the value will come up in the future. So, but new CMBS loan documents now require a pandemic reserve. I don't know if any of you have heard about that or seen that. And we are seeing servicers require that as a condition to a change of ownership. So you're bringing in a new capital source. It's going to be your partner, or you're going to sell the property and a new buyer assumes the debt. All these things could apply that I'm talking about. And I also want to say there's a big difference in the conditions of approval and the flexibility during the assumption, but for loans that are in special servicing versus master servicing. So if you have a loan in special servicing and you've missed a number of payments due to COVID, and you decide to bring in a capital source, or you decide to sell the property, you need to know that you're going to have more flexibility if you're in special servicing. But for the most part, you have to address all of the past due payments. In a sale, a true purchase and sale, they're going to require that the buyer actually come in and bring that loan current at the time of the sale. So bottom line, really, what I'm saying here is if you're bringing capital in or you're going through a sale, we should really talk about your particular property, your particular servicer, your particular pool, so I can give you some guidance. All that's free always. So I can give you some guidance on what I think the conditions will look like based on real time deal flow. And you don't, sign a buyer up, start the process, and then realize it's not doable after that. So it's different. It's different now that I don't know the right terminology. We're not post-COVID, but we're certainly hopefully on the tail end of it. But it is different once COVID hits. Last year, there's been much different analysis and requirements and things to think about and look at when you're bringing in new capital. Okay, so can defeasance be waived? I hate to word it this bluntly, but I will. I get asked this question just about every day. I don't know how many times every day, multiple times most days. Because here's what borrowers ask, and it's true, it's logical. You think, okay, so property's depressed, the value's depressed today. COVID hit, it's depressed. I could get out of this life. I could potentially pay the debt off and go get another loan and move on with life if they just waived defeasance. Or I could sell the property, the buyer could come in and pay cash if they just waived defeasance. And the short answer always is no, they will not waive defeasance unless, huge unless, there is no other reasonable way for the bondholders to be made whole through the life of the loan. So let me word that a little different. So let's say your property value, we'll use those values I used earlier on a smaller loan. So let's say the value of your property is 7.5 million and the debt is, I don't know, call it 7 million. And your maturity date is in a couple years, it's short-term in nature. And it's clear that it will not come back to anything higher than, call it 7.5 million over the next couple years. Well, then it might be, you might be able to argue that in fact, this is the only way we can all get out, is if you waive defeasance, let me pay you off and move on. But if you have a longer term on your loan, you've got another 5 years, 6 years, anything greater, it's going to be very hard for the servicers to ever be comfortable waiving defeasance and passing that, in essence, loss of return through the bondholders based on their decision to give relief in the lowest known valuation time demand, right, so far. So that's why they don't waive defeasance. They've got an obligation to these bondholders to give them their full return. So if your property was performing pre-COVID, it got affected by COVID, it's not a likely solution that you can get defeasance waived. Short answer. Okay, now let's talk about extensions of maturity date. Many borrowers that we worked with through the COVID relief process asked us to, okay, let's go in and get 12 months of relief, payments deferred, we'll pay it back over time, and our loan matures in 2024. I'm just going to use that example. If I could just get another 2 years extension, I think I can get out. But my property will not likely recover to pre-COVID levels by 2024. End result of what all we found through trial and error and asking 500 times, literally, was this. If your maturity date is in the next, call it in 2021, which I realize that's not very long now, but when we went in for relief, for COVID relief, if your loan matured in 21, you could probably get an extension of a year. We were seeing that. If your loan matured in 2022, it was possible and probable that we could get an extension, like another year. If your loan matured in 2023 and you're now getting, you're getting COVID relief right now and you're wanting to go ahead and add another year on the life of your loan in 2023, it's possible but not highly likely that they'd agree to maybe one more year at the end of the 2023. And if your maturity date was beyond 2023 and today you were asking for an extension, the answer is pretty unanimously no. And the whole reason is you have to understand that the servicers are all viewing this the same way. Nobody knows the future. Of course, none of us do. We can make all our projections of the planet, but nobody really knows where things will go, when they'll recover, and whether I'll recover in 23, 24, 25. We just don't really know that. And so because of that, the worst thing the servicers could do would be to grant relief that is later on not needed. That's their view, at least. So that does not mean if your loan matures in 22 or 23, you can't get an extension ever. It just means you're going to have to get closer to the maturity date to get that extension. And I know that sounds counterintuitive because you have probably all, if you've heard me speak ever, have heard me say over and over to be proactive, to plan ahead, to think about, if your loan's maturing in 23, don't wait, start approaching it in 22. And it's just under normal times, that is absolutely right. Pre-COVID, that was absolutely correct. But during COVID, if your issue is kicking the can down the road to make it through COVID, and oh, by the way, can you tack a year on my loan? Pretty much plan on no, unless your maturity again is really short term. Now, we are also, by the way, having a webinar on Thursday, the last quarterly webinar, and I've been doing these for 15 years. So the last quarterly webinar I'll do is this Thursday, and it's on creative capital. And what we're going to talk about there, and it's not me talking, I've got some fantastic industry experts that are going to speak about the types of capital available for either, JV preferred equity capital to help you through COVID, or capital to help you at the time of maturity. We're going to cover that. I encourage you all to sign in. That's Thursday. And you can sign in the same way you signed in for the CMBS 3030 call. From that point forward, all of the only presentations, if you will, or webinars that I'll do are these CMBS 3030 calls. And again, every 30 days, I'll cover hot topics for the last 30 days in 30 minutes. So I think to summarize and to wind up this call, there's like 7 or 8 minutes left. CMBS, as you probably all well know, is a pretty black and white, not pretty, it's a very black and white world. Things are very strictly regulated by IRS for the RMIC rules and Securities and Exchange Commission for the bonds. And yet we're living in a completely gray world. We have no idea what's really in the future. And that's never been the case before, really, where we really are in such a gray area. So the hard part about CMBS is taking this black and white, very structured finance vehicle and making it work for the nuances and the uncertainty of COVID in our world. So keep in mind, you can get relief typically, not everybody, not always, but typically you can get relief. It's not fun. It's going to cost money. It buys you time. You have to pay it all back. Typically have to guarantee it. And it will not meet your needs on the first round, but we are seeing the servicers again agreeing to kick the can again down the road, So hopefully we can get enough relief to, make it through what's really needed for the property. So with that, again, I encourage you to type in questions, send me on email questions that you may want addressed in any future of these calls. And otherwise, I appreciate your time today, and I hope you'll all sign up for the April 8th, this Thursday, webinar on creative capital. And I hope you found this informative. If not, I'd love to get your feedback because that's the sole objective of this call. So I hope you all have a great day. Thank you very much for your time today.